The silver market settlement system is sending a strange message. The price you see on a screen can fall fast, while the real-world cost to source bars, coins, or industrial form can stay stubbornly high. That gap doesn't automatically mean anything shady. It usually means the plumbing, delivery rules, inventories, financing, and logistics is doing something the headline price can't explain. Today I'll give you 3 takeaways. First, how silver settlement and delivery actually works in plain English. Second, why physical premiums and futures prices can separate for longer than most people expect. And third, the specific signals that help you judge whether this is cooling off or turning into a longer-running 2-tier market. And later, I'll point to one overlooked data point that often moves before the headlines do. Quick context on why this matters. Right now, silver sits in 2 worlds at once, industrial input and financial asset, and that combination can produce sudden stress when volatility rises. If you're a beginner, don't worry about memorizing every acronym. Focus on the cause and effect. Also, a simple disclaimer, this is educational content, not personalized advice, and commodities can be volatile, especially anything involving futures, leverage, or options. The goal is to help you understand what could be happening underneath the price so you can ask better questions. The core issue is that price discovery and physical procurement are not always the same activity. One is mostly financial, the other is operational. When they drift apart, you get confusion, investors see a chart, businesses see lead times, premiums, and contract terms. Let's demystify the warehouse language, because it's where many misunderstandings start. In U.S. silver futures, you'll often hear about COMEX inventory categories like registered and eligible, and you'll also hear about open interest, how many outstanding contracts exist. Those terms matter, but they don't mean what most people assume on first hearing. Eligible metal is typically metal that meets specifications and sits in approved facilities, but it's not necessarily committed to satisfy delivery today. Registered generally refers to metal set aside under warrants for delivery against futures. The common mistake is to treat all eligible metal like it's sitting there waiting for you. In reality, owners can choose not to make it available, can move it, can pledge it, or can simply hold it for their own reasons. Here's a simple analogy, just one, because we don't need more. The system can resemble an airline that sells many tickets while assuming only a fraction of passengers will demand a specific seat assignment at the gate. That can work smoothly, until too many people show up for the same flight at the same time. Now, how does delivery actually happen? Here's the step-by-step that turns paper into metal, and this is where settlement friction can appear. 1. A futures contract trades for months without anyone caring about delivery. Most participants roll, close, or offset. 2. As the delivery window approaches, some holders decide whether they want to stand for delivery rather than exit. 3. Clearing and exchange rules match delivery notices between shorts and longs, and the short side must provide the required form of metal through the approved process. 4. Warehouse warrants and specific bars are transferred through the system. Money changes hands, and the long receives title under the exchange's framework. 5. If the long actually needs metal in a different form, fabricated products, smaller bars, specialty rounds, or industrial feedstock, there may be additional steps: converting, shipping, insuring, financing, and sometimes waiting. Notice the key point: even when exchange delivery works, the last mile into the exact product you need can still tighten, and that's where premiums can rise even if futures fall. That brings us to the concept that explains most of the confusion: basis risk. Basis is the difference between the futures-linked price and the physical price you can actually transact at in your location for your product with your delivery timeline. People talk about hedging with futures as if it automatically locks in a purchase cost. It might reduce price risk, but it doesn't eliminate all procurement risk. Example: imagine a mid-sized manufacturer that uses silver in coatings. They hedge a portion of expected needs using futures, thinking they've stabilized costs. Then volatility spikes. The futures price drops, but local wholesalers widen premiums due to immediate demand, cautious inventory management, higher financing costs, or slower fabrication. The company discovers the hedge offsets the screen price move, but not the widening premium, not the freight cost, and not the delay risk. That doesn't mean futures are useless. It means the hedge was incomplete for the real exposure. In markets like silver, the paper price can behave like a financial asset, while the get-it-delivered and usable price behaves like a supply chain. So why might this kind of disconnect show up more often in recent years? Think in layers: macro, micro, and mechanics. Macro layer: interest rates and the cost of carry matter because holding physical inventory requires financing. When funding is expensive or credit is tighter, fewer participants want to warehouse large buffers, and they demand more compensation to do it. The US dollar also matters because silver is globally traded. Currency strength can shift buying behavior and regional flows. Industrial demand matters too: solar, electronics, brazing alloys, medical uses. Many applications can't easily substitute away quickly without redesigns, certifications, or performance trade-offs. Micro layer, refining capacity, fabrication bottlenecks, shipping insurance, and regional taxes can all create local tightness even when global mine supply looks fine on paper. Mechanics layer: in stressed conditions, participants may prefer cash settlement or alternative transactions rather than moving metal, which can keep the futures market liquid while the physical market feels constrained. None of this requires a dramatic narrative. It's enough that incentives change. Another piece many investors miss is how volatility interacts with collateral and positioning. Futures markets are built on margin, and margins are not fixed. When volatility rises, exchanges and brokers may increase margin requirements. That can force leveraged traders or commodity funds to reduce exposure quickly, sometimes selling because they must, not because they want to. Mechanism: higher margin means more cash needed to hold the same position. If cash isn't available, positions get cut. Impact: selling pressure can hit the futures price hard and fast, even while the physical market doesn't instantly loosen because metal doesn't teleport into warehouses and fabrication doesn't scale overnight. Example: a diversified commodity strategy runs multiple positions with risk limits. A volatility spike increases margin across the book. The fund deleverages broadly, and silver gets sold alongside unrelated commodities. That's not a judgment, it's how many risk systems behave. The practical takeaway is that price can move for balance sheet reasons, while availability moves for operational reasons. And those timelines don't match. Who is exposed when the paper versus physical relationship stretches? Several groups, and they experience it differently. Investors holding bullion products may feel it through higher premiums, longer shipping times, or less favorable buy-sell spreads. Traders in futures feel it through basis moves, liquidity shifts, and the risk that correlations break in stressed windows. Mining companies and refiners can be caught between benchmark-linked pricing and customer contracts that reference different points in the chain. Manufacturers feel it most directly. They don't care about winning a debate on Twitter. They care about continuity of supply and predictable costs. There's also a policy layer. Many governments have been paying more attention to critical inputs and supply resilience, sometimes via incentives, sometimes via stockpiling, sometimes via industrial policy. Silver isn't always named explicitly in those programs, but it's embedded in a lot of modern technology. The macro link here is simple. When supply chains are treated as strategic, the private market's just-in-time approach can shift toward just-in-case. And that can tighten certain forms of availability even if the global commodity is not truly scarce. If you want signals instead of vibes, here are the things to track. Choose a few and follow them consistently. First, changes in registered versus eligible categories and how they trend around major delivery windows. You're watching for whether deliverable supply looks like it's rebuilding or staying stubbornly thin. Second, measures of physical silver premiums in key regions and products. Not every premium matters equally, so focus on consistent benchmarks. Third, futures delivery activity. How many contracts appear to stand, how quickly inventories respond, and whether the process looks routine or strained. Fourth, indicators tied to financing and tightness, lease rates, repo-like stress in broader markets, or widening spreads that suggest balance sheet constraints. Fifth, ETF flows and large reported inventory movements, not as a perfect map of the physical world, but as sentiment and positioning clues. Sixth, retail and sovereign mint lead times as a last-mile indicator, useful, but don't confuse retail bottlenecks with the entire wholesale market. And here's the overlooked data point I mentioned earlier. Watch exchange for physical style activity and related spread behavior. When participants increasingly swap futures exposure for off-exchange physical arrangements, it can hint that different parts of the market are choosing different settlement routes. Now let's put a framework around what could happen next without pretending we can predict it. Think in three broad paths. Path 1 is reconnection, volatility cools, financing conditions stabilize, inventories rebuild, and physical premiums compress back toward normal ranges. The upside condition here is straightforward, smoother logistics and less balance sheet stress, so the futures price and physical transaction prices start behaving like they're part of one system again. Path 2 is a lasting two-tier market. Futures remain the most liquid reference, but physical practical steps and common mistakes, because understanding is only useful if it changes how you monitor risk. First action step, match your instrument to your goal. If your goal is long-term exposure, know the difference between owning physical, an ETF structure, mining equities, and a futures contract. They can behave differently when spreads widen. Second, treat leverage with extra caution. Many blowups happen not from being wrong, but from being early while margined. Third, if you're tracking this as an investor, build a simple dashboard, just 3 to 5 indicators from the list, and update it weekly so you don't anchor on one dramatic day. Fourth, when you hear claims that the price is fake, translate that into a testable question. Are physical premiums rising? Are delivery mechanics tightening? Are inventories changing? Are financing conditions shifting? The common mistakes are A. Assuming the spot quote equals your achievable buy or sell price, B. Ignoring transaction costs and product form, C. Overreacting to one data point, and D. Concentrating risk in one trade idea. Here's a mini recap before we wrap. The chart price is not always the same as the procurement price. Registered versus eligible is about deliverability, not total existence. Volatility plus margin can move futures faster than metal can move. Premiums and lead times tell you about the last mile of supply. Basis risk is the gap you must plan for, not a rounding error. Track a few signals consistently, and let the data update your view. So where does that leave us? The calm way to approach this is to stop treating silver as a single market and start treating it as a connected system: futures liquidity, warehouse categories, regional physical premiums, and financing conditions. The silver market settlement system matters because it's the bridge between financial trading and real-world transfer, and when that bridge looks stressed, the knock-on effects can show up in hedges, spreads, and volatility, even if you never touch a futures contract. If this breakdown helped, like the video and subscribe for more market structure explainers without the hype. And I want one focused comment from you. If you had to watch only one signal for silver right now, would it be inventory, categories, physical premiums, or delivery activity? And why? Final risk reminder: commodities and mining-related assets can move sharply, and leveraged products can magnify losses. This is educational, not financial advice.